Welcome back to Investing Talk Podcast.
Today we're looking at SanDisk.
And if you haven't looked at your trading screen today, you might want to sit down first, or maybe grab a drink, because what we are looking at today feels less like a stock chart and a little more like a rocket launch that has completely lost contact with mission control.
It's an understatement, really.
SanDisk stock just closed at $665.24. That's the close for Tuesday, February 3rd, 2026.
It is a staggering number. It really is.
It is a 15.4% jump in a single day. And if you zoom out just a little, I mean, this stock is up 143%.
In January alone.
In January. And since the spinoff from Western Digital, we're talking nearly 950% gains.
It's one of those rare moments where the market just completely re-rates a company in real time. It's looking at a business and saying, we were wrong. This isn't worth X, it's worth 10 times X.
So the mission for this deep dive is pretty simple, but the stakes feel terrifyingly high. We need to answer one question. Is this the ultimate infrastructure play for the AI revolution, the actual plumbing that makes data centers work, or is this a bubble that is about 5 seconds away from bursting in our faces?
That is the billion-dollar question. Or in SanDisk's case, I guess, the multi-billion-dollar question.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really, really helps us keep this analysis coming.
Okay, let's unpack this. We have to start with the numbers because, honestly, when I first saw the Q2 2026 report, I thought there was a typo.
No typos here. This is the fuel for the rocket. We just got the earnings report, and revenue hit $3.03 billion.
Wow.
That is up 61% year over year.
61% growth. Now, let's pause there. For a software startup, a hot new app, 60% growth is great. But for a hardware manufacturer, a company that has to physically build chips and ship them.
And deal with supply chains. Yeah, that is almost unheard of. But the number that really blew my mind, and I think caught everyone off guard, was the earnings per share.
The EPS is where the story really, really changes. This is where the surprise was. Wall Street was forecasting roughly, $3.49 a share?
And they thought that was aggressive.
They did. SanDisk came in at $6.20.
They didn't just beat the estimate, they nearly doubled it. That is a 77% beat. I need you to explain this to me, because usually memory chips are a commodity business. It's like selling grain. You fight for pennies.
You're absolutely right. Historically, it is a commodity game. But this result, it comes down to one thing. Margins. Gross margins expanded to 51.1%.
51.1. And for context, the prior quarter, they were what?
They were sitting at 29.9%.
Hold on. They went from basically 30% margins to over 50% in 3 months.
In 3 months.
That is massive. That's the kind of margin expansion that usually takes companies a decade to achieve, if ever.
And that tells you one very specific thing about the market right now. Pricing power. It means customers are so desperate for this specific type of storage that they are willing to pay a massive premium.
They can name their price.
They can name their price. It's like selling water in the desert. You don't have to put it on sale.
Right.
And if you think 51% is high, look at the guidance. Management is projecting Q3 revenue to jump to between $4.4 and $4.8 billion. But the margin guidance is what caused the stock to just explode.
What are they calling for?
They're calling for 65 to 67% gross margins.
67% margins on hardware. Those are software numbers. That's like SaaS numbers.
Adobe and Microsoft have those kinds of margins, not hardware makers. It indicates a severe supply and demand imbalance that isn't going away next week. We are seeing a structural shortage.
Okay, so they're making money hand over fist. But I have to play the skeptic here. Why SanDisk? I mean, there are other players. Samsung, Micron. What is the moat? Why can't someone else just flood the market and undercut them?
That is the key competitive question. And it comes down to the specific technology mix. SanDisk has established leadership in what's called BiCS8 technology, and specifically 3D NAND, that is optimized for AI data centers.
Okay, let's unpack that. BiCS8 3D NAND. We hear these buzzwords all the time. But why does an AI data center actually care? Why can't they just use the regular SSDs I have in my laptop?
So think of it this way. Imagine your city is running out of space. You can either build out into the suburbs, that's, 2D NAND, the old stuff, or you can build skyscrapers. 3D NAND is stacking memory cells vertically like a skyscraper. BiCS8 is essentially building a taller, faster, more efficient skyscraper than anyone else right now.
So they are packing more data into the same footprint.
Exactly. But it's not just about space, it's about speed. AI inference, when the AI is actually answering your question, requires massive amounts of data to be accessed instantly. If you use old-school storage, your expensive NVIDIA chips are just sitting there idle.
Just waiting for the data to arrive?
The storage is the choke point. So if you are building a billion-dollar data center, you aren't going to cheap out on the storage. You buy the best. And right now, SanDisk has the best skyscrapers.
That makes sense. So the demand is for the premium stuff. But building these factories, these fabs, is incredibly expensive, isn't it?
It's astronomical. A modern fab can cost $10, $20 billion. And this brings us to SanDisk's other ace in the hole, the joint venture with Kioxia.
I saw that in the reports. They extended it through 2034. Why is a contract extension such a big deal?
It's huge for capital efficiency. By partnering with Kioxia, they share those R&D costs and capital expenditures. While competitors might be struggling to fund capacity expansion on their own, SanDisk is splitting the bill.
So they get the capacity without blowing up their own balance sheet.
Exactly. And that helps explain why their cash position is so strong right now.
Speaking of cash, let's look at the balance sheet, because usually high-growth tech companies are just loaded with debt.
Not here. They have a net cash position of $936 million. And that is after repaying $750 million in debt.
So they're debt-light, cash-rich, and printing money with 67% margins. It sounds, well, almost too perfect. I want to circle back to those margins. Jumping from 30 to 50 to 67%, that just screams shortage spike to me. You know, it feels temporary. Is this sustainable?
That is the classic fear in semiconductors. It is a notoriously boom and bust industry. It's often called the hog cycle. Prices go up, farmers breed more pigs, then prices crash.
Right.
But the counter-argument here, and what the bulls are betting on, is the AI data cycle. We aren't just buying new phones, we are replumbing the entire internet.
Right.
Demand for inference storage is just beginning. Projections suggest this supply gap could last into 2027.
So instead of a quick spike, we're looking at a prolonged period of undersupply, a super cycle, if you will.
That's the term, yeah. A super cycle.
All right, let's pivot to the charts, because the fundamentals are great, but the price action is, well, it's parabolic. We closed at 665. Looking at this chart, it's practically a vertical line.
It's what technical analysts call a blue sky breakout.
Which sounds lovely, but what does it actually mean for a trader?
It means there is no overhead resistance. There is no historical price level where people are waiting to sell because they're finally back to even. Everyone who owns the stock is in profit. It becomes a purely psychological game.
And the volatility is just wild. A 15% move in a day for a company this size. It's moving like a crypto token.
That's a fair comparison in terms of velocity, yeah. It has cleared all the psychological resistance levels, and the structure of the chart, it's gone from a steady climb to an exponential curve.
What about the volume? Is this just like a few retail traders going nuts, or is there real money behind this?
There is massive volume. We saw unusually high activity recently, around 247,000 contracts traded. And the options flow tells a fascinating story. Call options are just crushing puts.
So people are betting on it going even higher.
They are leveraging up. But it's not just speculators. This is the S&P 500's top performer for the year so far.
And that matters for the big funds, right? That's a huge deal.
It matters immensely. It creates a feedback loop. If you are an institutional fund manager and you don't own the top performing stock in the S&P, you are underperforming your benchmark. You have to answer to your boss.
So they're forced to chase the price, the dreaded FOMO fear of missing out, but for billionaires.
Exactly. They have to buy it just to keep up.
Now, there's another element here fueling this fire that we have to talk about, the short squeeze. I saw some estimates that short losses were around $3 billion recently.
That is a lot of pain.
Explain how that works exactly.
So a lot of people looked at SanDisk's run-up last month and thought, this is too high, too fast. So they shorted the stock betting it would go down. But when the earnings beat was this big, the price jumped.
And the shorts are just, deeply underwater.
Deeply underwater. They get margin called, which means they are forced to buy the stock immediately to cover their position. Their buying drives the price up even further, which forces more shorts to cover.
So the bears are accidentally becoming the biggest buyers.
Precisely. That technical pressure is absolutely fueling this velocity. It's like pouring gasoline on a bonfire.
Let's move to sentiment. What is the street saying about this? Because usually when a stock goes up 900%, analysts start screaming, sell.
Surprisingly, they aren't. They are chasing it. Bernstein just hiked their price target by 72% to $580.
Wait, hang on. The stock is at 665. The analyst target is lower than the current price.
That happens in these super cycles. The price moves faster than the compliance departments at the big banks can update their reports. By the time they publish a target, the stock has already blown past it. Wow. But the sentiment underneath is clear. Zacks named it the bull of the day. The IBD composite rating is 99. Literally a perfect score.
So the consensus is strong.
It's a moderate buy to strong buy across the board. The narrative has completely shifted. 6 months ago, SanDisk was a cyclical memory stock. Now, it's labeled critical AI infrastructure.
That rebranding is worth a lot of money, apparently.
It changes the multiple you're willing to pay. You pay a low PE for a cyclical stock. You pay a high PE for tech infrastructure. The market is deciding SanDisk is the latter.
And the big money is confirming this.
Oh, yeah. We've seen institutional accumulation. RWC Asset Management initiated a large position. The flows show that funds are rotating out of other sectors and piling into this one.
Okay, I have to be the buzzkill now. It's my job. We have a stock up 143% in a month. Everyone loves it. That usually makes me want to run for the hills. Let's talk about the bear case. What could go wrong?
It is healthy to be skeptical. And the first risk is simply vertigo. Valuation.
Right. Trees don't grow to the sky.
Even with this growth, the valuation multiples are expanding so rapidly. It's priced for perfection. If they miss earnings by a penny next quarter, or if guidance is just good instead of spectacular, this stock could drop 20% in a day.
The higher the pedestal, the harder the fall.
Exactly. And then you have the cycle risk. We talked about the hog cycle. Memory has historically been a brutal business. When margins hit 67%, what do competitors do?
They build more factories, they flood the market.
They ramp up production as fast as humanly possible to chase those profits. History tells us that eventually, supply catches up, prices crash, and we end up with a glut. If that happens faster than the market expects, SanDisk stock will get crushed.
So if a competitor figures out a way to ramp their own 3D NAND faster, that premium pricing just evaporates.
It's gone. And there's also the broad market risk. SanDisk is now a high beta stock.
Meaning it swings harder than the rest of the market.
Right. If the NASDAQ has a bad week, SanDisk will have a terrible week. If we see a rotation out of tech, this is going to be the first one sold because it has the most profit to lock in.
So if you're buying here at $665, you are essentially betting that the AI infrastructure build-out has zero hiccups for the next 2 years.
You are betting on the supercycle thesis, winning out over the boom and bust history. You're betting that this time is different?
This time is different. The 4 most expensive words in investing. So, what's the verdict? We've got the fundamentals, the insane chart, the hype, and the risks. Where do we land?
If we look at the data objectively, the bullish score is a 9 out of 10.
9 out of 10. That is incredibly high given the run-up we've just seen.
It is high, but here is the core thesis. SanDisk is currently a pure play on AI data center storage. The shortage of high-performance NAND is real, verifiable, and projected to last.
So the fundamental driver is valid.
Yes. Revenue growing 61% with margins heading towards 67% is just. It's so rare, you almost never see that combination of scale and efficiency. It justifies a premium valuation.
And the main catalyst?
The Q3 earnings guidance.
Yeah.
It suggests the acceleration isn't over. They are telling us, explicitly, we're going to make even more money next quarter.
So what's the time horizon here? Is this a trade or an investment?
This looks like a multi-year hold into the AI cycle peak, which most experts are pegging around 2027.
But I hear a but coming.
But, and this is a massive but to entry matters, the chart is parabolic. Buying after a 143% monthly run-up is just dangerous trading.
So don't mortgage the house to buy at the top today.
Correct. This is a buy the dips situation, not a FOMO at the top situation. If you get a pullback, that's your opportunity. But betting against this trend, trying to short the top,
A great way to lose a lot of money.
it's a steamroller. Don't stand in front of it.
Just wait for it to slow down, then hop on.
Exactly.
Okay, let's wrap this up. We have a company that has reinvented itself from a commodity storage maker to the backbone of the AI revolution. Margins are exploding, the chart is vertical, and the smart money is chasing. But gravity is still a law of physics, so watch your entry points.
And keep an eye on those gross margins in Q3. That will be the signal. If they slip, the whole story changes.
That wraps up our look at SanDisk, a 9 out of 10 on the bullish scale, but handle with care. Make sure to subscribe, like, and comment to this video to support the show. We'll see you next time.